travel for the day. Clearly, it's continued upward momentum in the oil price. In the open in Asia today, we've got a big bounce up after a big bounce up yesterday. This morning, we've got Brent up 4.5, well, both Brent and WTI knocking on the door of $110 essentially, which must have made relatively uncomfortable reading, so to speak, for the State of the Union address that just finished. President Biden, his first State of the Union speech. Peter McGuire, CEO of XM Australia. Peter, does any of this matter, whether Biden's sanctioned or not? The reality is that Russian oil is going to be coming off the market. Traders don't want to touch it with a barge pole, including a minus $18 discount barge pole. So Russian oil might as well be sanctioned. Your thoughts?
Yeah, well, that's so true, Sean. And it just comes down to as far as global demand and how that plays into the market over the next, month or two. So all the moving parts need to be examined. We understand also energy and gas consumption coming out of Europe and Asia. So this is unusual times. And we're building on the SWIFT system. We're building on over the weekend what that entailed and the impact of Russian banks and to the economy and the ruble and so on. So we sit here and, like it or not, at $110 a barrel, the loser certainly is the consumer globally. The producers are rubbing their hands with glee, and inflation's out of control, and all of those impacts need to be considered to what we're feeling in Main Street and when we fill our cars up at the pump.
Peter, just following on from that, we also have the announcement overnight of IEA 60 million barrels of SPR release, again on the eve of OPEC plus meeting. How do you think, the reporting from the news agencies and others is it's going to be a simple rollover meeting, nothing to look at here, we're just sticking with what we got. Do they need to think about other things? Are these other things likely to come into their conversation, do you think?
Well, it could well do, Sean. The impact what it's had to the market has been the market's gone parabolic in the last 24 hours. So as far as the interpretation from a trading perspective, we're at 110. So, you wake up overnight and it's up 7 or 8%. So there's the first part. So that's the interpretation from a trade perspective. The second part is the sensitivity with this whole argument. There are so many components that need to, I think, certainly be considered. Where's the SWIFT system and what impact that's going to have to the Russian economy? What is the relationship? And having been to OPEC many times and seeing the way that the body language between the Russians and certainly the Saudis is and the UAE, you would have to say that they're singing from the same hymn book. So this could really, I think, from many different parts, I'm interested to see what comes out of OPEC and their mood towards their brother being Putin and Russia. So the interpretation is going to be, if you play really hardball, maybe we all band together and change the fabric to move ourselves to possibly being dealt and paid for in gold or crypto. I'm even thinking along those sort of lines, Sean, and I'm hearing that mooted across many different traders. So that's a different scenario altogether.
Peter, given that point, ultimately, where is the market at the moment? Because we have kind of baked in the idea that, at least only a few weeks ago, that there was a growing momentum towards a much more robust tightening. And you were asking in your own daily commentary about would New Zealand go the 50 points or would they go the 25? And they obviously went the 25. But how big a disruption is Ukraine to the tightening cycle, and hence central banks' ability, monetary policy makers all over the world, to get ahead of inflation when clearly now they will not get ahead of inflation? And how should we adapt to that reality and stop fooling ourselves that they were ever maybe going to do it, but nonetheless, certainly not going to do it now?
Well, exactly, Sean. If we put our minds back only couple of maybe, I don't know, 6 or 8 weeks ago, I can't recall the number, but it'll be around then. And Jamie Dimon said we're going to see 7 rate rises this year. So it was only in September last year, and there was talk that you may not see one. Then it was all of a sudden the velocity picked up October, November, then it really started to gather an incredible pace. I'm hearing some analysts are even saying now we're back down to 5, possibly 4. So everyone has a different view, and the view is very much, as Randall mentioned, the explosion to the upside as far as inflation. They can't seem to rein it in with high energy costs and high everything else as far as food. So it's going to be difficult to manage those expectations, and what tools, naturally the Fed, but the other side, as far as the consumer is going to appreciate, higher rates, higher mortgage costs, higher cost of just living with high inflation and higher costs. I think it's going to be a pretty tough year on the consumer in 22, Sean. And I think the Fed's got to take a pretty much an even keel sort of approach, because they can get ahead of themselves if they start ratcheting up too quickly. You've got to think of the other side as far as growth and what's happening to the domestic economy in the US. And with now the situation with the Ukraine, that really puts the focus, I think, on that matter. And that's where everyone's got their focus at the moment. I think that Jay Powell will certainly make comment regarding that.
I mean, in your neck of the woods too, Peter, again, the Asian demand piece, you've got the $110 oil and you've got the strong dollar. So you've got the double whammy here. Where do you see dollar going? Flight to safety?
Well, I have to be, Sean. We're at 97.45 at the moment. That's a US dollar index. So it's had a very, very solid move to the upside in the last 4 to 5 weeks, creating much opportunity for traders with that huge volatility swings. And it just seems to be ratcheting up. And that flight to safety, as we all understand, Biden's address and the storyline as far as Fed coming into play in March, I know it's all baked in, but that flight to safety, I think there's a 98 handle there for US dollar index, maybe in the next week. So that continual grind up from here, 97.5, we haven't got far to go.
Absolutely. Let's go to the survey question. It's hard to say. I mean, OPEC Plus, they couldn't pick a worse day to meet, maybe be a record. It won't be a 16-minute meeting. It'll be a 2-minute one. But the question is, do OPEC Plus need to consider the disruption to Russian oil supplies when they meet today to map out April's supply? Do they need to consider the disruption to Russian oil supplies, i.e. that this is now a reality? Russian oil supplies, whether they're sanctioned or not, already are the disruption has happened, has started. How big it will become? You've got Exxon pulling out, BP, Shell, OMV announced their plans overnight to withdraw. I mean, there are more long-term impacts, but ultimately on the shipping and trading side as well, there's a big pullback from the Urals. Do OPEC need to consider this in their thoughts? Let's go to the survey result. Give Peter the last word. A big overwhelming yes, OPEC need to pay attention here. Peter, the question on that, just to follow on from that for you to close us out, is how solid are these prices? We saw a quick drop off only last Friday when there was some indication that oil wouldn't be sanctioned. That I'm wondering how inflated the geopolitical piece of this oil price is, and how quickly could it change with a headline saying, the foreign minister of China, for example, is going to meet with foreign minister Lavrov and have a chat.
Well, that's risk premium and that geopolitics building to price, Sean. Like this, I think we're at 94 or $95, 96. I can't put my mind back to where we were Thursday or Friday, but it's just had such a massive ramp up since then. So there's probably, the way it's going with the velocity, there's probably $8 to $10 at least worth of risk premium, and it would strip out very, very quickly. It could come out in a session or two if there is some piecemeal deal done between all parties and it gets sorted. But if this becomes a protracted situation of what we've seen in the last, demonstrated in the last couple of days as far as price, why can't you see a 125? Why can't you see a 130? It could go all the way to 140. I'm not going to herald those prices, but there's every possibility that if this starts to magnify and Saudis come to the party as far as backing their brothers, Russia, this could really become quite ugly for the consumer.
Well, let's going to have to wrap it up there on the relatively not so positive. I was going to say in my close, and I'll say it as well, I just don't see how this all doesn't lead to stagflation. Perhaps we're already there.
That's it, Sean. That's where it runs.
And you've got to position your policy, your portfolio, your decision making with that in the frame. And we saw what happened to Japan over 20 years when they dealt with that. Not a good one. Let's wrap it up there. Will there be an Iran deal? That's the subject of our halftime talk this week, and another part to consider. Thank you, Randall. Great to have you as always. Albert, thank you so much. Peter, thank you. Have a great week, everybody. Every morning, 10:30 UAE time, we'll be here batting it. All the best.
Thanks, Sean. Thanks, Albert.
Cheers,
Thanks,
guys.
Randall.